Hey, greetings. Dr. Jeffrey Scott here. It is Sunday night, or yeah, it looks like night because we have thunderstorms in Florida. Actually, it's mid-afternoon on Sunday, about 3 o'clock. Just got back from a wonderful time off coast of Miami where I spent the weekend on my boat. I did a video on Thursday night, and obviously the market has not traded since then except for the futures. And I guess the internationals may have had some activity. I want to just do a follow-up video and just to go through when I find a stock and I talk about a stock in one of my videos that I'm interested in, how will I actually trade it and how do I look at if I'm going to trade it. So I'll look at a couple of stocks that I think look interesting here and then I'll dive deep into one and show you the options trades that I would consider. Now, a couple of things. I am not an options educator. I don't consider myself an options educator, but I've learned a lot about options over the years, and I've learned to trade them the way I want to trade them. So what you're going to see might be different than others will show you. I'm not going to talk about um, trades in a neutral market. That's not very exciting. I'm going to look at directional trades on a stock as an alternative to buying the stock. The other thing I want to mention before we start is, you know, one of the things I showed you on Thursday is the markets are overbought and the stocks, the 13-week highs versus lows are at a level that one would expect us to have a correction. And we did see some weakness in the futures on Thursday night into Friday when the futures market closed. Now, it's possible that we'll reverse that in a couple hours when the Sunday market opens. It's possible we sell off, but I think it's also possible that we don't do a big sell off and that we just continue to see kind of aggressive rotation underneath the surface. So I am cautious a little bit because we're extended. Obviously, I saw those futures, but I'm not saying that this is over. So I'm going to look at some picks to the long side. And if you haven't been here before, marketmripro@gmail.com is my email address. And if you like these videos, you want to be invited to my free education, just join my Google group. It's called Top Down Trader. As always, these sessions are for educational purposes only. Any recommendations I make are in the spirit of education, not investment advice. The intent of this and all my videos is to demonstrate the tools of top down and how I apply them. Trading involves risk, and you are solely responsible for any investment decisions you make. I may own or intend to buy or sell any stock mentioned in this report. Trading stocks and options should be considered risky and should consult with your financial advisor before making trades. And I have tools in multiple platforms, but I am an independent trader. I mentioned my Google group. Just Google Groups. Go to the site, search for Top Down Trader, sign up for it. You'll get added to my essentially a mailing list. And I put videos out every day pretty much to that list. News and earnings are always important. And of course, this is last week's, so we won't pay attention to that. I'm not used to doing this video, but I thought it would be kind of fun. So let me just pull up the, give me a second. I'll find the news and earnings for this week because it's important that you keep track of those. I keep track of them because I recognize that if I don't know when an earnings date's coming, it's my own fault, and therefore I want to know. And you could see it's a relatively light news week, especially on Monday. We'll learn something from the Fed minutes, although I think we had enough Fed heads talking about what they think, and then jobless claims on Thursday. And when I see Delta, I know that we're about to start the next round of earnings. So let me kill that. So first, let me walk you through some of the stocks that I liked when I did my review. One of them is Chart Industries. Now, why would I like Chart Industries? I look at a lot of charts. I like to find stocks that have pulled back but are in an uptrend. Now, you could certainly argue that Chart Industries, let's look at a weekly. has been in a rocky road here and pulled back pretty hard. But this was a massive reversal candle. We took out the top of that line, and that line came from the daily chart. And you could see that I went across prior highs. We broke out. Here is seasonality, 5 and 10-year seasonality, which is reasonable. So I don't have to worry about seasonality going against me. On a low volume day, it actually had higher volume than the day before. It had PSAR supporting it, and the relative strength versus the moving average versus, since relative strength versus the spider is above the moving average, which is bullish, and the volume OBV is above the MA, which is bullish. And up here, when I look at the high jump, it's 39.48, which is neutral. So this has got a lot of parameters that I like. Clearly, if you go back to here, it's been in a longer term uptrend. Another one I liked, and we're going to look at them, and then I'm going to pick which one I'm going to talk about. ServiceNow. This is an expensive stock, but to me, it's kind of the king stock in the AI from a support perspective. They have a lot of systems to support the cloud. We use them. We like them a lot. Clearly in an uptrend. If we look at a weekly chart, you can see this has been a huge winner. Let's go to a monthly. A big winner of the AI trade. Why I liked it, sideways move, caught up with the 50 and had a nice move up. You see it was in a squeeze, which is what you get from a sideways move. Both the relative strength and the OBV are crossed above the moving averages. It had momentum, volume, and what I call my CPR and my EMS signal. So this one has a lot to like here. And what I thought was interesting when I looked at it in daily graphs, showing my age, and market surge, it's traded right into the pivot area, which is where things kind of get interesting as well. Now, the downside of this stock is it's a very expensive stock, and even a wealthy person at $1,000 per share is probably going to be limited to how many shares they can buy. Another one that I liked is GTLS, and it just has a pattern that I like. And again, it's a stock that's sold off. It's now been in an uptrend since all the way back in April. A little bit of a pullback here and a breakout. A breakout on better volume than the prior day. Momentum, relative strength, and OBV look good. So GDS, and we look at seasonality, it's kind of neither here nor there. It's not positive nor it's negative. TripAdvisor, if you look at bookings and some Expedia, they're doing well. And TripAdvisor, I thought looked interesting, breaking out of this trend line here. Seasonality neutral. Again, you look down here, you see relative strength and OBV are great. You could see that it had 3 momentum dots in a row. And those that follow me know that that's one of the signals that I look for. I look for 2 of them is enough for me. 3 is unusual. It also had volume and a gap. Now, the only challenge with this one and why I might not chase it is after 3 giant days, the high jumps at 100%. And that tells me it's likely to want to pull back a little bit. So I might want to watch it more than I want to buy it. BAM, uptrend, higher than the slow up pullback and starting to move off of the 50 and white. Again, it had momentum and both of these are crossing over appropriately. RBRK, rubric. Now you might be thinking, why aren't you showing me NVIDIA and Apple and Google? That's what everybody shows you those. I'm looking for new meat. I'm looking for new opportunities. Things that might be rotating that are not big names. This is a stock that had a great run from earlier this year, or actually April, earlier this year. And big reversal here. Traded down to the 50. Had a CPR and a momentum signal. Hasn't quite crossed here, getting close. So that's one I want to watch closely. And then GTLS, Chart Industries. So if I look at the high jump here, it's not extended. So the one I'm going to pick to work up is going to be chart industries. And then if it doesn't take too long, I'm going to look at now. Now I love, but it's an expensive stock. And even if you play options, as I'm going to talk about how I would evaluate this stock, they're not cheap. So let's start with looking at GTLS. Seasonality is good. I come up here, I look at the earnings date is August 1st. So I'm probably going to buy options that are beyond that date because it's a little short for me to buy monthly Julys. But I don't have to hold it beyond that date. They're looking at 262 versus 218. So that's 44 cents. That's about a 20% growth rate. The multiple is only 16.57. I can live with that. It's had beat its earnings growth multiple quarters in a row. Had a small surprise this past quarter. That's pretty good. Let's look at market surge. So why do I keep calling it daily graphs? That's what it used to be called. Hold on a second. I forgot to shut that down. And then it became Market Smith, and now it's called Market Surge, and they sold it to Dow Jones. So we'll see if it stays as good. This is GTLS. And there's no reason not to use all your assets to help make a decision is what you're going to do. Here it looks kind of sideways, doesn't it? Not that exciting. This is exciting. $11 growing 38%. So even if that multiple at 19 doesn't increase, let's just call it 20, that's a $220 stock for 25. And then you look, if 20, again, it's higher than the current PE, so why wouldn't the PE expand? But if it doesn't, that's a $280 stock if it stays the PE is the same. So I like that earnings per share growth. I don't like this sideways movement, but I would take a run up to 220. So let's work up chart industries. First question should be, do I just put a buy order in and nothing else? And that answer is no. I would look at the last trading day, and I see that the high was 1673. Oh, excuse me. That's not right. Hold on a sec. Yeah, it is. Open at 167.73. That was the low. Closed at 173.63. That was the high. So I'd probably require the stock to trade to 173.75 before I would buy it. So I would put my order in at think or swim. And why am I doing that? Well, I mentioned before the market might be topping and we could see a pullback or at least a pause to refresh. I may not want to be chasing a new stock purchase at the open if the market's down 200 points. So I like to put my buy order above the close. Why 12 cents? Why not? I mean, you could put a nickel, a dime. I'll just put 12 cents. Maybe I'll put 13 to get above that 75 cents. All right. Now, if I was buying the stock at 173.75 and I was going to be willing to let it risk, say, 6%, that's over 10 bucks. So if I was to just buy the stock, and where would I put my stop? We should look at that too. So the way I trade, I'm going to put my buy just above this. So we said one. All right, so I have to put a stop. Now I am willing to risk up to $10 or $12 on this trade. 1, 2, 3, 4. I'd probably look at this here. What is this stock at? So the low here is 160.41. I can do that. That's about 12 bucks. So I might look at putting my stop at the bottom of this doji. I look at the lowest low of the last 4 days. So let me just pull that up and we'll put a line there. And now I'm going to adjust it a little bit. I've got that 200-day moving average. I might move it up to just below that 200. So I'm putting my stop at about 160.94. What's that 200 at? That's 50 cents. That's fine. So that's kind of where I'm putting my stop. That's my buy signal. I don't enter a trade, whether I'm buying the stock or doing an option trade, without knowing where my buy is and then where am I going to close the trade if it goes against me. So if my buy is at 173.75 and my stop is at 161.42, that's fine. All right, that means I am risking about $12.30. So I might want to put a target somewhere that's equal to what my risk is. And that would put me up to 12, 185-ish. All right, that's fine. And so I would look at this trade, and since I'm concerned a bit about the market, I might design a trade that doesn't fill till I take out this top line. My stop would be placed immediately so I won't end up losing more than what I'm willing to risk. This would be R1, and since I think this market is getting toppy, I might actually take half of my position off at R1 and then let what's left run. And then I might move my, not might, I would move my stop to break even. And unless there's a big gap against me, I would actually make money on that trade. So let's go look at potential options positions on Chart Industries GTLS. This program is not my program. It's called Options Pro. And I'm going to type in GTLS, hit enter. And I am going to, actually, let's go in here. So I want to look, stock is 173. I want to look at $10 spreads on the different option positions. And then the types of trades that I typically take: long stock, long call, short put, maybe, maybe not, cover call, bull put. And I want to talk about these trades as potential. Now, the first thing to remember is this is an expensive stock. And if you wanted to buy 100 shares of a stock that's $173, you were looking at over $17,000. And not only are you looking at over $17,000, which isn't horrible, the thing about buying, I'm just adjusting this, sorry about that, about buying the stock, which I have no problem with, is it uses up a lot of your money. And if you trade with margin, you'll still do okay. The benefit of owning the stock is if this is where you buy it, the first dollar is profit, first dollar loss is loss. This is the P&L curve for buying the stock. What I already mentioned, I was willing to risk about 12 bucks, I think we said on the trade. So even if my stops work and I buy the stock, all I can really lose on the trade is $1,200. So the benefit of buying the stock is that you get this beautiful P&L curve, and you don't have to move to cover the cost of an option. But the downside is dollar for dollar, you can go up or down. So this is great. I have no problem with buying the stock. Let's spend a few minutes and ask the question, are there trades that might be less expensive where I have less risk and a lot of upside? So a lot of people like to buy a call. And I have nothing against buying a long call. I do this all the time. I have to figure out where that long call is going. It should have opened up. Oh, Yes, I have a lot of programs. Okay, so now we have a long call. So the long call has advantages and disadvantages. So instead of spending $17,000 to control 100 shares, I only got to pay 1,210. Now the downside with the long call is it can go to zero if the stock goes down. But all I'm going to risk is $1,210. Well, if I was going to risk $12 a share and I bought 100 shares, all I'm risking is that same $12. So that's okay. And the best part when you are risking premium is if the stock was to gap down, the most you can lose is that same $12. What I don't like about this trade is for it to become profitable, it's going to have to move to $182. Why? Because I'm paying $12 for this call and the current price, well, it's going to have to move potentially to 185 depending upon where I end up buying the call. So it's a debit, which means I have to pay for it. I have to move the amount of that debit before I break even. I have limited my downside, which I love, and I still have the infinite upside. So buying a long call is great. And let's write this down. A long call is going to cost me 12.10. And that might be the right trade to take. Let's open up another one. How about if I want to lower that, I can just sell a call against it, and I can look at a bull call spread. And what happens with the bull call spread, my cost to get into this is only $5 per share. And if I get one contract is 100 shares, my cost is going to be $525. So my risk just broke down in half from 1,200 to 5.25, but my profits went from infinite to 475. I'll take this trade on a now that's super duper expensive, but on this stock I probably would not go for this trade because I'm capping my upside on something that I'm very bullish on. All right, what about a bull put spread? Looks exactly the same. The benefit of the bull put spread is you've collected premium here, which is $345. So the stock can actually move up to $345 and you break even. If it's less than 345 move, so it could go up a little bit or it could go down up to $345 on the value of your option or your spread, and you still break even. So you collect a credit, so it's cheap. You've limited your downside here to $6.55 an option or $655, but you've also limited your upside to that money you collect. So even if it goes down in value some, you don't lose money right away, and that's a great thing. It's a cheap trade. I don't like this trade because it's too much limit on my upside. All right. How about a married put? This turns out to be one of my favorite trades, and I don't take it enough. And sometimes I use it, after you've had a couple bad trades and your confidence is down. I love this trade because let's look at this trade. And it's not fair up here, and I'll tell you why. You can buy 100 shares of GTLS and then guarantee that by a put at $170 that you're going to pay for $8, that the most you can lose on this trade is $11. Think about that. I said I'd be willing to lose up to $12 on this trade. Here, for a debit of $800, which is cheaper than the $1,210 of buying the call, I'm able to control 100 shares, and I have limited my bottom, and I have unlimited upside. And since I'm paying less for the option than the call, I have less to move before I turn profitable. What did I forget to tell you? The same thing if didn't put here. You still got to buy 100 shares, and that's 17,300. So what happens is you're paying the share price of 173.63 plus an additional $8. And what you're doing is you're ensuring that you will not be that you're ensuring the ability to sell the stock at no less than 170 by the expiration date of the put. But look at this. Doesn't this look just like a call at less money? Still have the same downside. I think this is not a bad either. So right now, we like the call and we like the married put. How about a butterfly? Ooh, I don't like that butterfly. Could you imagine trying to stick this landing? This is a bad trade as far as I'm concerned because you pay almost nothing. You pay $135 to control 100 shares. But you got to land at the tip to get the maximum. And if you traded beyond 180 or less than 160, you lose money. So I would not do this. But look, I can do a couple of different things with this. One thing I could do, and what I love doing, is say, let's take this to 200, where my target could be as high as 220 here. Let's take this to 190. So I've got $20 I can make on this trade. And look what we created. We created a butterfly that has a broken wing. And a broken wing butterfly means that, let's take a look at this. I've got to pay $1,390 for this trade. So it's more than a call. But I have potential, if it doesn't move a lot, to make a lot of money with my maximum gain here is $1,610. And if I picked a butterfly and I was right on the name of the stock and I thought it was going higher and I was right on the direction, and a typical butterfly, I would have ended up negative because out here because it had such a big move. But the benefit of the broken wing butterfly is I can take a trade, and as long as I'm right directionally, even though it's a butterfly, I can still do really, really well. I like this trade, and just the way this trade works is it doesn't have to move much at all for me to be profitable. So remember that if I had to pay 12 bucks for a call, it had to move 12 bucks to turn positive. But with the way I structure this butterfly here, the long call is already $13 in the money. It doesn't have to move hardly at all for this to be profitable. So what I've done is I've given up some of my unlimited upside in exchange for a trade where if it moves a little bit, it's positive, and if it moves a lot, it's positive. I don't have to buy the stock first like with a married put. So for a similar cost as a call, $1.90 more, but similar, I'm able to buy an option spread that is positive even if it doesn't move much. Call, you got to move the amount you paid for the call. So this is going to be one of my favorites, and that here is called a broken wing butterfly. And you could play around. If I didn't want to spend this much on the butterfly, you could play around. Right now I've kept 30 on this side, 10 on the short side, so I'm plus 20. I could have done 20 and 10, made this 180 and 190. This is how I like it, so that's a broken wing butterfly. All right. What about call ratio back spread? These are tough ones. They're great trades, but they're tough ones. And the benefit of the call ratio back spread. Let's talk about this trade. I'm selling one at the money. and I'm buying two that are $10 out of the money. So the first is like, it's like doing a short call spread on something you like, and then taking the money from that short call spread and buying the second call. Sorry about that. Buying a second call, and you're hoping that you get a big move, because if you get the big move, you have to cover. So you're going to get paid on this trade. You're going to pay $1.60. You're going to have to move $10 just to trigger the second call. So it's 1160 before is the most you can lose. And then every dollar forward, you're going to make money on that long call. Now you have to move all the way to 190, 160 to break even. It's a cheap trade. It's only costing you 160, but don't be deceived. You lose money up until you get to that 180. Now, if the market goes down and the stock goes down, you're not going to hurt yourself. In fact, the most you could lose is that 160. But if you have something that's going to move a lot, if you have a reason to expect that, you've got a ton of upside at a low cost. And then the last trade that I look at is I call it a chicken shit synthetic, but let's start with a synthetic. Hey, that looks just like owning the stock, but I only have to pay $410 to control 100 shares. And I'm getting a call that's $3.63 in the money, and a put that's not even in the money. I have the exact same pattern as owning the stock, except I've got to move $4 for it to be profitable. But I still have the unlimited downside. Now, I love this trade. I still take synthetics. Usually I do the next move I'm going to show you. But one thing that I've learned is be careful of position size. If you are willing to spend $12,000 to control, or $1,200 to control 100 shares, does that mean you buy 300? No, it doesn't, because you have risk to the downside. But here's a way I can protect this. I can edit the spread, and I'm going to buy a put underneath that 170. So I'm going to add an option leg. I'm going to buy a put. Let's just say I'm going to buy a put at 160. So now I'm going to pay $866 for this trade. I'm going to risk the $10 here plus that 860, it's 865, 1865, and I have to ask myself the question, do I want to buy this stock, this trade here, where I only have to move $8.65 to be a winner, or do I want to buy the call where I have to move 1200? Well, I would probably buy that synthetic personally because I don't have to move as much. I manage the option just like I would a stock. I have a target. I have a stop loss. If I hit my target, I usually sell half my contracts. I'm not going to buy one contract. I usually buy 20, 30, 40, or 50. And I will manage the trade. I will look at where I'm at a day or two before earnings, and I'll consider taking profits at that time as well. So what I wanted to show you was how I could use a number of different option trades that could give me the choice. Do I want an expensive trade? Do I want a high likelihood of being positive? Do I want unlimited downside? Do I want unlimited upside? And then picking the trade that matches my appetite. I'm going to look at that synthetic versus a call on this trade. I hope you have a great rest of the day. I hope you enjoyed how I look at these. And when I look up here, what I really am looking for is where is infinity, meaning unlimited upside? Where is my cost lower and my maximum risk is controlled? Have an awesome, awesome Monday. Let's be careful this market. I'm a little bit nervous that this market is going to have a little bit of a tariff tantrum for a couple of days. It's just too obvious with the markets at extended amount. And I guess Tuesday is, what did he call it? Um, Independence Day, #2, whatever he called that day. It wasn't a great day when he came out with the tariffs the first time. Hope you like this. Give me comments. I can do it again. Thanks.